It wasn't a glitch in the trading algorithms. It wasn't a temporary supply chain bottleneck. It wasn't even a speculative bubble driven by retail frenzy. It was the structural breaking point of a two-tiered reality, a reality where price and value have ceased to speak the same language. We are witnessing a divergence that has not been seen on this scale for nearly a century. The screen says one number. The physical market demands another, and the gap between them is not an error, it is a measurement of the system's fragility. The pattern is unmistakable. The arithmetic is merciless. When a monetary system reaches its mathematical limit, when the debt burden exceeds the productive capacity of the tax base, suppress the paper price, acquire the physical asset, and wait for the inevitable reconciliation. This is not a conspiracy of shadowy figures in a back room. It is a rational response to a collapsing paradigm. The incentive is survival. The payoff is generational wealth preservation. The risk is being left holding a claim on an asset that does not exist under these constraints. The rational move is to hoard the real thing while selling the illusion. History is littered with the wreckage of paper markets that claim to represent reality, but reality always asserts itself. It asserts itself in the cost of bread, in the cost of energy, and in the premiums paid for physical metal over paper promises. We are watching the separation of the map from the territory. The map says silver is cheap. The territory says silver is scarce. And the entities with the deepest understanding of this dynamic are not selling, they are buying. They are removing supply from the visible market. They are positioning themselves for the moment the map burns. This is not the first time this has happened. The mechanism of price suppression followed by a violent upward revaluation is a historical constant. It is a recurring feature of late-stage imperial monetary cycles. We have seen this specific sequence of events play out before. We saw it in the 17th century. We saw it in the 20th century, and current data suggest we are watching it unfold again right now. The pattern is rigid. It does not care about technology. It does not care about political ideology. It obeys only the laws of supply, demand, and solvency. To understand why the paper price of silver is $71 while the physical price hits $130, we must look at the historical precedents. We must examine the moments when the facade cracked. The story begins 2,000 years ago in an empire that thought it was eternal, but found itself trapped by the same arithmetic that binds us today. In the year 64 AD, the Roman Empire stood at the apex of its geopolitical dominance, yet underneath the marble veneer the fiscal rot had already begun to metastasize. The Great Fire of Rome, which consumed 10 of the 14 districts of the Eternal City, was not merely a tragedy of urban planning or a moment of imperial madness. It was a fiscal shock of unprecedented magnitude that forced the hand of the Emperor Nero. The treasury was empty, drained by the immense costs of imperial administration, the wages of the legions stationed from Britannia to Judea, and the bread and circuses required to keep the Roman mob from revolt. Faced with the impossible cost of rebuilding the capital, Nero made a decision that would echo through the next 3 centuries. He did not cut spending. He did not raise taxes, for the provinces were already squeezed to the breaking point. Instead, he ordered the mint to recall the silver denarius. The denarius was the backbone of the Roman economy, a coin that had been roughly 98% pure silver for centuries, a standard of value recognized across the known world. Nero's mint masters melted down the existing stock and reissued the coins with a slightly lower silver content, approximately 93%, and slightly reduced the weight. To the average shopkeeper in the forum, the coin looked the same, it felt the same, it carried the same face value, but the emperor had magically created liquidity where none existed. He had stolen a fraction of the wealth of every saver in the empire to pay for the state's debts. This was the first turn of the screw. By the time we reached the crisis of the 3rd century, the pattern initiated by Nero had accelerated into a catastrophic feedback loop. The incentive for every subsequent emperor was identical: to pay the soldiers and avoid assassination. They had to debase the currency further. By the reign of Septimius Severus in the early 200s, the silver content had dropped to 50%. By the time of Gallienus in the 260s, the silver content was less than 5%. The coins were no longer silver, they were bronze slugs, washed in a thin coating of silver that would rub off after a few weeks of circulation, revealing the base metal underneath. This was the Antoninianese double denarius that claimed to be worth 2 silver coins, but contained almost zero silver. The reaction of the Roman economy was a textbook example of Gratian's law, though the term had not yet been invented. The good money, the older high-purity silver denarii, disappeared from circulation instantly. No rational actor would spend a coin made of 90% silver when they could spend a coin made of 5% silver if the state enforced that they had equal face value. The citizens hoarded the old silver. They buried it in clay pots in their gardens. They melted it down into jewelry. They removed the physical reality from the market and transacted only in the debased paper-equivalent bronze slugs. The divergence between the official value of the coin and its purchasing power became absolute. In 301 AD, the Emperor Diocletian attempted to fix this broken mechanism not by restoring the silver but by issuing the edict on maximum prices. This was a massive bureaucratic effort to dictate the price of every good and service in the empire, from a bushel of wheat to the wages of a camel driver. The penalty for violating the price controls was death. The result was not stability, it was the total disappearance of goods from the open market. Merchants refused to sell at the official price because it was below the cost of production. In real terms, the economy bifurcated. There was the visible market, which was empty, and the invisible black market, where goods were traded for real silver and gold at prices vastly higher than the imperial edict allowed. A soldier in the legions paid in the debased currency found his wages could buy nothing. His salary in nominal terms had increased, but his purchasing power had collapsed. The state pretended the money was sound, the market knew it was not. The friction between these two realities tore the social fabric apart. Trade networks collapsed because trust evaporated. Why ship grain from Egypt to Rome if the coin you receive in payment is worthless? The empire devolved into local barter-based economies. The complex interconnected trade system of the Pax Romana disintegrated because the medium of exchange had been weaponized by the state. Against the people, the hoarders of real silver survived. Those who held the state's currency were destitute. Just like the Roman debasement created a split between the official currency and the real economy, the Spanish Empire in the 16th and 17th centuries faced a similar crisis of valuation, but driven by a different mechanism. The Spanish Empire did not debase its currency by removing silver. It destroyed its economy by importing too much of it without increasing productive capacity. Following the discovery of the massive silver deposits at Potosi in present-day Bolivia in 1545 and the implementation of the mercury amalgamation process, which drastically increased extraction efficiency, Spain was flooded with wealth. The annual treasure fleets, the Flota de Indias, brought hundreds of tons of silver into Seville every year. The Spanish crown believed this metal was synonymous with wealth. They were wrong. This influx of silver struck an economy that was rigid and unproductive. The arithmetic of quantity theory of money took hold because the amount of silver money increased drastically while the amount of goods produced, cloth, wheat, ships, arms, remained relatively stagnant. The result was the price revolution. Prices in Spain multiplied by a factor of 4 or 5 over the century, a rate of inflation that was incomprehensible to a medieval society accustomed to stable prices. The Spanish crown, led by Philip II, used this silver to finance endless wars across Europe. They borrowed against future silver shipments, leveraging the physical metal before it even left the mines of the Andes. The juros, or bonds issued by the Spanish crown, where the paper promised the silver in the galleons was the physical collateral. But the spending outpaced the mining. The demand for war material outstripped the supply of real wealth. The divergence here was between the perceived power of the Spanish state and its actual solvency. The crown defaulted on its debt in 1557, again in 1575, in 1596, in 1607, in 1627, and in 1647. Each bankruptcy was a reset. Each time the bankers, the Fuggers and the Welsers of Germany, the Genoese merchant houses who held the paper promises were wiped out or forced to restructure the physical silver, however, flowed through Spain like water through a sieve, ending up in the hands of the Dutch and the English who produced the actual goods Spain needed to buy. The Spanish middle class was decimated. A weaver in Toledo could not export his cloth because the domestic inflation made his prices uncompetitive abroad. Meanwhile, foreign goods flooded in cheaper than local products. The wealth of the silver mines hollowed out the productive core of the nation. The rational move for a wealthy Spaniard was not to invest in industry but to buy land titles and church annuities, to retreat into hard, non-productive assets that could weather the inflationary storm. The paper wealth of the imperial bonds eventually became worthless during the defaults, while the physical land and the physical silver that had escaped the country retained their value. The empire crumbled not from a lack of money but from a surplus of money that had no connection to productive reality. Just like Spain found that an abundance of currency does not equal wealth, the Weimar Republic in early 20th century Germany demonstrated what happens when the disconnect between paper and reality becomes terminal. In 1914, the German gold mark was a solid currency backed by gold trading at 42 to the US dollar. By 1923, the paper mark was a tragic joke trading at 42 trillion to the dollar. But the path from stability to collapse was not a straight line. It was a series of widening divergences between the official narrative and the market reality. During World War I, Germany suspended the gold standard to print money for the war effort, betting that they would win and pay off the debt with reparations from the Allies. They lost. The Treaty of Versailles imposed crushing reparations. The industrial heartland of the war was occupied by French and Belgian troops in January 1923 to extract coal and steel in lieu of payment. The German government, unable to fight militarily, chose to fight financially. They ordered a general strike in the Ruhr and printed money to pay the wages of the striking workers. This was the moment the dam broke. The government was printing money that represented zero production. It was a pure paper claim on nothing. The velocity of money exploded. A worker would be paid at 1100 a.m. and rushed to the nearest shop to buy anything: a bar of soap, a hairpin, a stale loaf of bread, because by 1200 p.m. the prices would have risen. But here is the critical detail often missed: the stock market in Weimar Germany soared in nominal terms. The paper index went parabolic. A casual observer looking at the stock charts might have thought the German economy was booming. It was the Katastrophenhaus, the catastrophe boom. People were fleeing the currency and buying shares in companies, not because the companies were profitable, but because the shares represented ownership of factories, machines, and inventory, real assets. However, the divergence between the paper price of gold and the official exchange rate was the ultimate arbiter. They railed against speculators and hoarders, but the black market knew the truth, and the countryside farmers refused to sell produce for paper marks. They would only trade for gold watches, silverware, or foreign currency. Their lifetime of labor was reduced to zero. The paper mark price of a gold ounce reached trillions. But if you actually had a gold ounce of physical gold coin from the pre-war era, you could buy an entire city block in Berlin. The breakdown of price discovery was total. The price of bread in paper marks was irrelevant, because the bread was often not available for paper. The real economy had fully detached from the monetary system. The reset, when it finally came with the introduction of the Rentenmark, was not a continuation of the old system. It was a complete repudiation of the paper past. Stage 1 is sound money. The currency is backed by a physical asset or a rigid discipline. Trust is high. The economy grows based on productivity and savings. The map matches the territory. Stage 2 is overextension. The state or the empire takes on obligations it cannot fund through taxation alone. This could be a war, a welfare commitment, or an imperial expansion. The budget deficit appears, but it is dismissed as temporary. Stage 3 is the first betrayal. The government realizes it cannot pay its bills honestly. It chooses the path of least resistance: debasement. In Rome, this was coin clipping. In the modern era, it is quantitative easing or yield curve control. The money supply is expanded faster Then the supply of goods stage 4 is acceleration. The initial debasement creates a false boom. Asset prices rise, the state feels vindicated, they double down. The deficits become structural, the printing becomes a permanent feature of the economy, not an emergency measure. Stage 5 is the Great Divergence. This is the critical phase. Inflation begins to appear in the real economy. The state intervenes to suppress the symptoms. They manipulate the consumer price index. They sell paper contracts of gold and silver to knock down the price of the monetary metals, which serve as the alarm system for the fire. They create a paper price that is lower than the physical price. This is the era of shortages, long delivery times, and high premiums on physical assets. Stage 6 is the crack-up boom. The population realizes the currency is losing value. They flee the currency en masse. They buy anything that is not nailed down: real estate, stocks, art, commodities. The velocity of money spikes. The central bank loses control. The divergence between the paper price, which the government tries to manage, and the street price, which reflects reality, becomes unbridgeable. Stage 7 is the reset. The system collapses under its own weight. The currency is either redenominated, backed by a new hard asset, or replaced entirely. The paper wealth is wiped out. The holders of physical assets carry their purchasing power through the transition, just like the Roman citizens burying their silver denarii to escape the debased bronze, and just like the Weimar farmers demanding gold watches for potatoes. Current data suggest we are deep into Stage 5 and rapidly approaching Stage 6. The evidence is found in the behavior of the largest players in the financial system. We are seeing a historic anomaly in the silver market that mirrors the divergences of the past. The paper price of silver on the COMEX futures market hovers around $30, and at times the screen price shows stability. Yet reports indicate that physical silver, the actual metal you can hold in your hand, is commanding premiums that push the real cost significantly higher, with some specialized physical items or immediate delivery demands, implying a valuation far detached from the futures contract. But the most alarming signal is not the price, it is the movement of the inventory. JPMorgan Chase, the behemoth of the American banking system, has amassed a stockpile of physical silver that is estimated by some analysts to be nearly 40% of the relevant market inventory. Why would a bank whose business is ostensibly lending money and earning interest turn itself into the world's largest vault for a non-interest-bearing metal? The incentive is clear. They are positioning for the reconciliation. The COMEX market operates on a fractional reserve basis. For every ounce of physical silver in the registered vaults, there are hundreds of ounces of paper silver traded in the form of futures contracts. These contracts are promises to deliver silver, but they are rarely settled in metal. They are settled in cash. This system works fine as long as the holders of the paper are content with cash, but when confidence erodes, the paper holders stand for delivery. They ask for the metal, and this is where the math breaks. If even a small fraction of the paper claims demanded physical delivery, the vaults would be emptied in days. The paper price is the price of the promise. The physical price is the price of the reality. We are seeing the gap widen. The paper shows $71 figure referenced in some analysis models suggests where the price should be if the currency debasement were fully priced in, or perhaps where the derivatives imply value in a stress test. The $130 physical figure represents the extreme scarcity premium in a breakdown scenario. While these specific numbers fluctuate, the dynamic is constant. The paper market is a tool for price suppression, allowing major entities to accumulate the physical asset at artificially low prices. Before the inevitable reset, critics will argue that this time is different. They will say that digital technology, high-frequency trading, and central bank coordination can manage the spread. They will argue that silver is merely an industrial metal, not a monetary one, and that its price is dictated by solar panel demand, not monetary collapse. But this argument ignores the monetary history of the world. Silver has been money for 4,000 years. It is the people's money. When the currency fails, the public does not buy treasury bonds, they buy silver. The industrial demand is real, and it is growing, which only tightens the physical supply further, but the monetary demand is the driver of the divergence. The central banks are buying gold at record paces: China, Russia, India, Poland. They are exiting the dollar system. The commercial banks like JPMorgan are mirroring this move in silver. They are hedging the collapse of the very system they preside over. The endgame arrives in one of three ways, and the order is fixed. First, we see controlled decline. This is the current phase. The authorities attempt to manage the inflation. They manipulate the data. They use forward guidance to placate the markets. They allow the currency to lose value, slowly hoping to inflate away the debt without triggering a panic. This is the boiling frog strategy. Second comes chaotic collapse. The slow decline accelerates. A shock hits the system, a war, a bank failure, a pandemic. The trust evaporates. The paper markets for gold and silver freeze or disconnect completely from physical reality. We might see the COMEX declare force majeure, settling contracts in cash because they have no metal. This is the moment the paper price becomes zero and the physical price becomes infinite in paper terms. Third comes reset and restructure. The authorities introduce a new system. It might be a central bank digital currency, CBDC, tied to a basket of commodities. It might be a return to a partial gold standard. Whatever it is, it will involve a revaluation of hard assets to balance the books. The holders of paper assets will be bailed in or inflated away. The holders of physical assets will own the collateral of the new system. In 1933, Franklin Roosevelt confiscated gold to revalue it from $2,067 to $3,500. In 1971, Nixon closed the gold window and gold went from $35 to $850 over the next decade. The reset always involves a massive transfer of wealth from those who trust the paper to those who hold the metal. The only variable is timing and pain. The mechanism is set. The leverage is built. The physical inventory is moving into strong hands. The window to exchange paper promises for physical reality is closing. This is not a call to gamble. It is a call to study the history of the asset you work for and save. In the divergence is the warning siren. Pay attention to who is selling the paper and who is hoarding the metal. Subscribe to stay ahead of the data. Educate yourself on the mechanics of custody and counterparty risk. Build resilience in your supply chain and your savings. The map is not the territory, and the territory is about to quake.